Josh Brown making the case that there is no better place to be than invested right here in the U.S. right now. There is the tweet. You'll hear from the man himself in a moment. No ECB rate hike in 19, probably no rate hike here either. A coin flip for a rate cut. China stimulating like crazy. Japan is Japan. Brexit a 2025 story. You want to be out? Legitimate question to ask investors right now.
Yeah, and I think it's less a market timing. It's not a call. It's like a question everyone should ask themselves. Like what? So you want to go into risk-free? You want to go into 3-month bills and sit there and wait for some event? You certainly could do that. But what is the negative that this market has not spent the last 15 months pricing in? We are essentially below where we were in January 2018. It's a very long time with no progress. And in the meantime, earnings growth has been there. And the Fed basically took itself off the table. The ECB this morning took itself off the table. I understand that led to a spike in bond prices and a compression in yields. But I'm not sure that that's an economic story here. So I'm just thinking out loud. It's not, hey, the market's about to skyrocket 30%. But what else do you want to do? And I don't know that there's really a better answer.
So what fundamentally changed for you? Because I know a couple of months ago you kind of felt differently. You felt as though maybe the lows would get challenged, or you felt maybe the market was in a
I still think, yeah, it's a good question. I still think that's possible. I do, because you've been talking about a range, and I agree that we're in a range. And I think in this case, the range is very well defined. But we're way closer to 28.15, which I think is the breakout, than we are to the lower end of that range.
But is it just the Fed that has you thinking this way?
I think we're in this part of the year where historically, and I got into this the other day, the economic data softens and everyone says, okay, this is it. We're about to have this recession, and it doesn't end up coming, and we firm up a little bit as we get into the spring. And I don't see why that pattern would break this time. And in fact, that pattern may have actually been reinforced by the fact that we had a 40-day government shutdown, 700,000 people sitting at home or going on a vacation and not doing their regular thing. So if you start to see that pattern come back again as it has in prior years, I think people say, all right, I took some off the table. Look, market's flirting back with its old highs. And yes, we understand the global economy. It's not growing as fast. It's slowing. Okay, how much of that is priced in? And I think a lot already is.
Steph, makes sense?
Yeah, and some of it.
I mean, it is a largely, if you look at the tweet and the major points of the 5 that are made or thereabout, 3 of them are central bank related. ECB's not raising rates anytime soon. Not only aren't we raising rates anytime soon, we could be cutting rates. Now, you could make the case that would not necessarily be good for stocks, because if we have to cut rates, that would signal that perhaps
Can I clarify that for you, Esker? So the cut rates thing, the market is implying that there are significantly higher odds of a rate cut.
Not only that, now moved into 2019 for
within
the first
2
time.
years. But part of that, it's a little bit technical. Part of that has to do with the term structure. And so that it's not quite a rate cut, but all right, whatever. Anyway, go. I'm sorry. I didn't really mean that we're about to have a rate cut.
Thank you.
All right, go.
No, I understand, but you think the next move could very well be a cut.
Well, the market does, yes.
I don't think that's the case, but
I hope not.
I think that the big question I have to ask is, why are rates lower? And is it a recession, or is it this central bank policy? And that's kind of keeping the lid on rates. Now, I do think certainly we are slowing. We've been talking about slowing for a very long time. Here in the United States, we knew we weren't going to grow 4% like we did last year in the second quarter. We knew we were going to slow. So how slow is it going to be? It's probably a little slower, exacerbated by trade, by the government shutdown, by the unease of businesses not wanting to invest because of all of these uncertainties. And then also, we have seen slowdown internationally, but we have seen it slow down internationally for 18 months. China was slowing before the trade problem. So I think this is well factored in, and this is the reason why China is stimulating. So there's a push-pull. Right? What's going to happen first? Are we going to start seeing the stimulus from China give us some green shoots and get us excited about global growth actually stabilizing and maybe getting better? Or is it going to be we slow so much here in the United States and we kind of go down this rabbit hole? I actually think the first quarter is going to be very, very soft in GDP and in earnings. And I've said it many times, and I think that is your trough of the year, because I do think as you go through this year, China's stimulus will impact the global growth, and lower interest rates is actually a good thing. So consumer, mortgages, also risk assets. So, I mean, did you guys see the mortgage app numbers today? third week in a row, up 9% today. So I think that's a really important point, that there are some good things from lower
Europe
rates.
needs China to stabilize more than we do. I know the big headlines are all about trade, U.S. versus China, but actually that softness is definitely affecting the global economy more than it is here. And that may have troughed based on what Stephanie is saying.